You're welcome back to my channel. This is regulatory platform where we discuss insurance regulation and supervision. We review global practices and we also bring local perspectives. In case you're joining us for the first time, my name is Dr. Sam Onyeka, and I'd like to gladly welcome you to this channel. In case you like what we're doing here, I will request you to subscribe to this channel. And when you do, remember to turn on your notification bell. This will enable you to obtain or receive notifications when we upload new videos. Once again, I thank you and welcome you to this channel. During the last episode, we discussed insurance premium regulation, and we explained the meaning of insurance premium and also the rationale for regulating insurance premium. We showed a necessary connection between insurance premium regulation and solvency of the insurer. In case you have not watched the video, you have opportunity to watch the video as we have supplied the link on the description box. All right. Today, in this episode, we are discussing insurance contract regulation. And simply, we are looking at how government has intervened in the other relationship that existed between the insurer and the insured, with a view to protecting the interests of policyholders. Let me quickly state that the insurance contract is a one-sided contract from the beginning, and the insurer has always designed the contract papers and put the terms and conditions of the contract the way he likes it. And what the insured does is to sign to the contract, and that's it. Well, some people look at this as technically insurance as contract of adhesion. Now, I want to let you understand, for the purpose of this discussion, that insurance contract can be divided into commercial contract and consumer contract. Now, with respect to consumer contracts, we are looking at those insurances you buy for your person, for your consumption, if you like. And a typical example is life insurance, life term assurance. And then with respect to commercial insurances, we are looking at those insurances you buy not necessarily because of your personal need, but because of the needs of your business or the needs of your profession. For example, those who are involved in aviation transport, they need to protect their interests by insuring the aircraft and the liabilities that may arise by reason of the operation of the aircraft. So we call this type of insurance contract as commercial insurance contract. Now, it's important to mention that the need to intervene, the need for regulation arises because of the fact that certain people are on equal position with insurers. Now, in this contract, like I said, for commercial insurance transactions, the multinational corporations, the governments, and very rich private companies have the capacity to negotiate or renegotiate the contract. They can hire lawyers, they can hire accountants, and they can even engage top insurance brokers who are able to negotiate with insurance companies and even negotiate the rates. So the challenge is more with respect to those who are involved in commercial consumer insurances. And so government has always thought of how to protect this caliber of people. And it is even much more relevant in jurisdictions, emerging jurisdictions, or jurisdictions where you have a lot of poor people. Recent time, as part of trying to develop insurance in the emerging jurisdictions, we have seen micro-insurance develop. And we see micro-insurance as the insurance that is targeted at the working poor. So there is need to protect these people. Otherwise, they may fall into exploitation that will affect their interest. All I'm trying to explain is the rationale for government trying to intervene in the first place. Ordinarily, under the law of parties autonomy, parties are free to decide what rules and what terms and conditions will govern their relationship. And the court will not intervene except and until it involves breach of law or public policy, if you like. Now, I'm going to show you briefly or quickly how government has intervened to protect the interests of policyholders. Always remember the type of policyholders I have in mind. I'm talking about those policyholders in relation to consumer insurances, where many of them are not even sufficiently literate enough to read and understand insurance contract papers. So now it's necessary that regulation should operate to protect the interests of such people. I'm going to now show you how this has been achieved. Now, when we began to regulate insurance business, we see many jurisdictions establishing regulatory bodies where they fix premium, for example, regulatory bodies where they go out to protect the interests of policyholders through licensing of insurance companies and regulating the operations of such insurance companies. Now, the major areas of this protection include licensing process. During the licensing process, the insurance companies are required, or applicants for insurance license are required to bring to the regulator the draft policy documents. And these draft policy documents are reviewed thoroughly and must meet certain minimum standards. One of such minimum standards is that the contract papers must be drafted in such a simplified way. Before now, we used to have a cake English. We have very lengthy documents that discourage policyholders from reading them. So now, in most jurisdictions, regulators require that the policy document should be as brief as possible and written in easily readable form and use modern language that the insured can easily connect to. Now, that's one. Now, number two, in terms of contract, the regulators have also come to insist that there should be no undue process. There should be no duress. And how do we find duress? Somebody may be coerced into buying a policy. He's traveling at the airport, you ask him to buy. You can come to his house when he's in good mood and get him to sign an insurance contract paper. But he doesn't really want to buy. He may be pressed by agents to buy insurance. So now regulators all over the world insist that you should give policyholders opportunity to reflect and decide whether they really wanted to buy the policy in the first place. And so there is room for withdrawing from the contract, if you like. So we call this free look period. And it is with particular reference to life insurance contracts, which are long-term contracts. So after the insured has signed into a contract, has paid premium, he's given between 2 weeks and 3 weeks, and in some jurisdictions, 1 month to say, I want to continue or I don't want to continue. And where he elects to withdraw from the contract, he will receive his premium. So this is one way regulators have tried to protect the interests of policyholders in insurance contracting. Now, I'm now going to leave this one aside for a moment, and I want to talk about the reforms that we have seen in the general law relating to insurance, the principles of insurance as we know them. Now, one of the major principles of insurance is utmost good faith. Now, from the beginning, those who develop insurance business discover that they have found a business that is outside the influence or the purview of existing law, and they have to develop new principles of law, albeit to guide and protect their interests. And one of such principles is utmost good faith. Now, what is utmost good faith? Utmost good faith is saying, as against the general principle of contracts, which is buyer beware or caveat emptor, we are looking at utmost good faith. Now, the insurer is saying that because I do not know much about the risk you're presenting to me, and don't forget, the insurance business started hundreds of years ago. We didn't have internet, we didn't have all manner of technology as we have now. So it was not possible for the insurer to know much about the risk. And so some of this information on this risk are said to be in the bosom of the insured. And so the only way the insurer will know the risk is from the information that the insured will provide. And so the proposal form was made the basis of the insurance contract and incorporated by reference. What it means is that whatever information that is given in the proposal form is considered correct and right. Now, if for any reason the insurer found that the insured has misled him, has given him information that was wrong or was misleading, the insurer was at liberty to cancel the contract and never return the premium. The insurer was at liberty to repudiate the contract and treat the contract as though it had never existed. Now, the complication is that over the years, we found that some unscrupulous insurance companies were repudiating contracts carelessly. And so it became necessary to find succor for the insured. And now we have seen many jurisdictions reforming the law relating to utmost good faith. Like I mentioned earlier, in England, for example, we have the Consumer Insurer Disclosure and Representation Act of 2012, and it's purely designed to protect the interests of policyholders in relation to the effect of disclosure and misrepresentation in insurance contracts. All right, let me come back to Nigeria, and I'll summarize because of time. Now, in Nigeria, for example, the regulator is very active and proactive, if you like, and is doing everything to protect the interests of policyholders, beginning from micro-insurance policyholders to the rest of consumer insurance policyholders. And the Nigerian insurance regulator has strictly enforced the free look period, as well as insisted on doing away with small prints, as well as ensuring that the terms and conditions of the policy are very favorable to the policy holder. I think that the current position of the law is adequate, and we are looking forward to incorporating this very profound provision of the Insurance Act 2003, specifically Section 54 and 55, into the new legal framework, so that we continue to protect the interests of policy holders. All right, this is the much we can take on this episode. I hope to see you sometime in the future as we come back with another episode. Meanwhile, my name is Dr. Sam Onyeka, and remember to subscribe to this channel. Thank you, and see you next time. Goodbye.